we are into good times. Our macro is doing well. At the same time, JP Morgan, though late, but they did include us. And now we have Bloomberg also coming in. Of course, in terms of amount, Bloomberg's not too large. So the incremental, we are talking about $22.5 billion, but it gives you a different weightage, right? So it's not just the tracker I would look at it. So maybe one would say just the tracking of funds, which is tracking the JP Morgan index, would be, say, $23 billion. And this would be $2.5 billion. So that would be $26 billion. But because of the momentum, because these two people have included, we would see a lot of other non-tracking guys also coming in. So I won't be surprised if we see $35 to $40 billion coming in with both these news coming in at this juncture.
Jayesh, what would this flows, in fact, in the last 3-4 months, FII flows into Indian debt actually have increased, even though they may have been selling in the equity market, but debt flows have turned positive. And now you're talking about flows even going higher because of inclusion of these global indices. On a more bigger landscape, if I were to take 3 to 5 year period, what usually happens to bond markets in countries where their indices get included into such, global indices? Does it become, the flow become more consistent, the market becomes bigger? What exactly is the trend which may actually take shape from here on?
People say, like, when you are included in an index with a weightage of 10%, and that's the general feel people say, then normally, even if you want to go short, if you're negative on that country, you would go short by 2% underweight. So maybe 8% still would be invested. And maybe you are going long. That's what generally people say, rule of thumb, that will go 2% overweight. And that's where, the range of delta is 8 to 12. But I think that's not really true. The delta could be 8 to 24. Because when your macro is good, it's not only the index guys, but it's other guys who are not tracking index. They also come in, because what happens is when you are not part of index and you as a fund manager takes a call on it, and if you go wrong, people are going to question you, right? But when you're a part of index and if something goes wrong, people are not going to question you that dramatically. So that from that perspective, the flows can actually go to $40-45 billion in good times, and I think our macro is looking pretty good. And as you were saying, some of the guys have already started coming in, so it's not even they are front-running the index. Of course, that's the backstop they have in the mind. But right now, the guys who are coming in are more for currency appreciation, because looks like we have kind of peaked out on our currency, and the best way to go long on INR is to buy government bonds.
Exactly, I wanted to come to next, because, help our viewers understand as to how this also spells out to be positive for the currency as well, because that definitely reduces our cost of funding.
No, absolutely. So, this year, like last year, we don't know whether equity flows will continue or not continue. We are all hoping that it will continue. But even if it does not continue, so the $22 billion equity flow, that will be kind of replaced by the debt flow, which was not there ever, right? So from that perspective, and of course our macro is doing pretty well, right? And as we do more China plus one and stuff like that, and the GCCs, the macro looks pretty interesting. As long as crude is not misbehaving above 100 for next foreseeable future, we should be pretty good on our currency. So there is definitely momentum that currency will appreciate. It's only how much at what speed that will depend on RBI.